you're a teenager right now, there's a pretty good chance you've heard people talking about stocks and investing. And it can be pretty overwhelming learning all this. So in this video, I'm going to give you the no BS guide to a strategy that gives teenagers the best chance of setting themselves up financially over the next few years. The best time to plant a tree was 20 years ago. The second best time? Today. People repeat this quote because it's true. And it's especially true when it comes to investing. The best time to start investing was probably years ago. The second best time is right now. Because if you don't start today, 10 years from now, you're going to be wishing that you did. Most people underestimate how powerful time is. They think about investing as day trading and making money next week, the next hour, the next day. But investing is really about putting yourself in a position where your future self could thank you. Before you buy a stock, you need to understand something really simple. The market moves in cycles. Nothing goes straight up forever. Nothing goes straight down forever. Markets trend upwards, but then they pull back. And then they trend upward again. Then they pull back. The mistake most people make is they become excited when prices are already high, and while they're buying, the big banks and institutions are selling. Then they become scared when prices fall, and while they sell, big banks are buying. And that brings us to the entire idea behind the strategy: liquidity. Most people lose money when they invest, so naturally to make money you just have to do the opposite of what other people are doing. When markets fall, people panic. And when people panic, they sell. Meanwhile, larger institutions and the uber rich often take advantage of this emotional decision making. And they do this through liquidity. The stock market needs buyers and sellers. For you to buy a stock, someone obviously needs to sell it to you. But big banks move so much money that if they buy a stock, they're going to push that stock price up. They don't want to do this because they want to buy the stock at the best price possible so that they can make more money. So what they end up doing is they cause the stock price to go down, causing more people to panic and sell. This causes a bunch of sell orders to flood the market. And guess what? Now big banks have enough sell orders to fill their buy orders to buy the stock at a good price, and then the stock could do whatever it wanted to do originally. If you want to take advantage of this, you need to buy on the side of the big banks. You need to be with them when they buy and be with them when they sell. To know when to buy a stock, you need to be able to read how it moves, and one way to do this is through the candlesticks. Some simple candlestick anatomy. A candle opens here, and it closes here. The wicks here are the lowest point of the candle, and the wicks here are the highest point of the candle. Each candle represents a specific time interval. If the candle closes green, that means that over that time period, the stock went up. If a candle closes red, that means over that time period, the stock went down. Now to look at all these candlesticks, I use TradingView.com, but you can use anything you want. The high in the market is when there's an up candle and a down candle, and the high is the wick. A low in the market is when there's a down candle and an up candle, and the low is the wick. Now let me give you the details of the actual strategy. Here is SPY. It's a compilation of the 500 biggest companies. But you don't care about any of that, you just care about the good stuff. Since the entire premise of the strategy is based around that you want to buy when the banks buy, that means that you want to buy a stock or an index when it dips below previous lows, because that's when most people are going to be selling. Most people are selling and panicking, that's your cue to buy. Indexes like ES and NQ usually move around 10% in an entire year. In this case, in 2 months, ES went 10% to the downside. If you put two and two together, you can realize that that means there's panic in the market. If an index is supposed to go up 10% in an entire year, it going down 10% in 2 months is a sign that there's overreaction in the market. But this doesn't mean that we should just blindly press buy and hope for the best. We look at it from the bank's perspective. Now they want to buy more of ES, but they don't have the orders to do so. So what they're going to do is create more panic by pushing price down lower towards lows where they see there's a lot of stop losses that could be filled. That is you, that is everyone else getting stopped out on their trade orders so that they could have some more money in their pocket. So what you need to do is you need to find those lows where most people are going to be losing their money, and instead you need to buy there. Now ideally you would pair this up with different levels, but that deserves an entire video on its own. The most important thing for you to understand is that strong pullbacks often create opportunities for you to invest and make money. While everyone else is focused on fear, investors are focused on values. That's the difference. And so here in this chart, you can see that there was a low here. And while everyone is panicking, it was going down, 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 down. If you waited for it to hit that low, which by the way aligns with the previous highs, but again, those are different levels that we'll talk about in another video. If you would have bought there, you would have been on the very bottom, catching the entire move to the upside. Now let me show you exactly how big of a difference this can make over the long term to build that generational wealth. So on average, savings account returns are about 0.5%, but you can easily find some online ones that are around 4% a year. Now indexes usually return around 10% a year. But if you pair this knowledge of being able to buy when it goes down and sell when it goes up, You could capitalize on your gains, but then buy lower so that you can make even more. If you would have bought it at this low, you would have made 20%. Now, assuming that this thing doesn't go up the entire year, it's only May, but assuming that it stays at this 20% level for the entire year, that's it. You have made 20% of your money. You might not think that's a lot, but let's actually put this into a calculator to see how much this could accumulate to over 10 years. Now, trading is a type of game where you need a lot of money to make a lot of money quick, but you don't need a lot of money to start. Now, most of my friends work a lot and they have a savings account of around $10,000, so I'm just going to use that. But you can use any amounts of money. The key is that you're building a skill, and when you're going to have that money, you're going to know how to spend it or how to invest it correctly. So I'm also putting that your monthly contribution could be around $150. That's not a lot of money to spend in an entire month. So putting that away and being able to spend that or invest that correctly could help you in the future. Using the estimated interest rate as 20%, which is basically saying that each year, let's say we have one opportunity, such as the one I just pointed out, which isn't true. You can have many opportunities. But let's say you have just that one opportunity. You could see that over 10 years, you'll have more than $100,000. Now, if you put this in a regular savings account, you'd barely have $36,000. And this is exactly what I'm talking about. You're going to be able to make that money on the side to fund your vacations and then use that money to build generational wealth. And a little pause, before anyone says this is not generational wealth, I am assuming that after 10 years, you're going to completely take your money out of the market. I'm assuming that in your 20s, maybe your 30s, you're going to just take that money and use it for something else. If you would keep that money and keep a $150 monthly contribution, which is going to be incredibly small if we're assuming that you're making around $50,000 a year. If you were to keep this going, and let's say you're lucky enough to live to around 70 to 80, you would have $1 billion. That is generational wealth. That is exactly what the rich don't want. They don't want you to be rich. They want you to be poor. They want to be rich. But if you do this, if you stay on their side, if you trade with their trades, if you trade with the banks, if you do this over a period of 60 years, you will make $1 billion. That is generational wealth. This isn't day trading. This isn't something that you have to do every second. And this doesn't even have to be your passion or your hobby. But if you are literate enough and able enough to be able to invest in the right spots, in these simple opportunities that the market presents itself when it crashes, when everyone else panics. If you keep your calm and you're able to invest, you're able to build generational wealth for your family. To be able to do what they want, and for your future kids and grandkids to be able to do what they want. And so this isn't at 1000%, 1000x meme coin gain. This isn't gambling. This is something you could easily do. You can make your family proud, you can make yourself proud, and you in the future will be thanking you for starting this right now. This is a genuine and very simple strategy that you could do to take your savings to the next level. You don't have to be on the charts 10 hours a day trying to day trade. You can pursue your own hobbies, but do this to become financially literate and make some money while sticking it to the man. And this is where future videos come in, because this video isn't meant to give you exact answers. It's meant to teach you how to think. In future videos, I'm going to look at what makes a company attractive, what levels to look for when trying to invest in a company, how to identify those, in the exact framework for you to use before investing to maximize the return you could get. And if you're interested, I'll also be talking about what stocks I personally look at. Not because I'm some millionaire investor, not because I have a secret formula, but because I think that learning these concepts early on can genuinely help you and change your future. Now, as corny as it sounds, if you're a teenager watching this, you have one advantage that most adults would pay millions of dollars to get back. Time. You don't need to become rich next month. You don't need to make $1,000 by the end of the day. You don't need to double your money next week. You just need to start learning. Start understanding the markets, start understanding business, and start investing in your future. Because one day, 10 years from now, it doesn't matter if you want to be this amazing stock investor or if you want to become a veterinarian or a basketball player. Now, if you enjoyed the video, subscribe, because in the next videos, we're going to talk about the actual genuine strategy, the stocks, the levels, and the specific things you should look for before putting money into the market. And until the next one, stay curious.